The global economy, a modern Ponzi scheme. In early 1920, an Italian immigrant living in Massachusetts managed to attract attention quickly by promising investors a 50% return in 90 days. Charles Ponzi's system was remarkably simple. He paid early participants with money from investors who came later. In the first months, everyone won, promised returns arrived on time, and the system seemed to work flawlessly. People convinced their neighbors, relatives, and co-workers, and in just 6 months, hundreds of thousands of dollars were collected. But there was a brutal truth of basic mathematics. Each new layer had to be larger than the one before it. The system required geometric expansion, yet the world and the pool of investors within it were finite. 6 months later, the system collapsed. Tens of thousands of people lost their investments, Ponzi went to prison, and his name became synonymous with financial fraud. But the structural logic he discovered never disappeared. On the contrary, it dressed itself in more sophisticated guises, and most importantly, it managed to operate under the protective umbrella of states. Today, anyone examining the foundations of the global financial system inevitably encounters this question: why does debt constantly increase? Why do debt levels rise even higher after each crisis? Why are governments, corporations, and households forced to live with increasingly more debt? The answer lies hidden in the fundamental operating logic of the system. Debt is not just the result of overspending. It is also the way money itself is created. Most people think money is printed by central banks or treasuries and put into circulation in the economy. The reality is much more complex and striking. In modern capitalist economies, the vast majority of money is never physically printed. Here's what most people don't realize. It is created by commercial banks as credit, as digital records. This process is called debt-created money and forms the fundamental operating mechanism of today's capitalism. The answer to the question of how banks create money is critically important for understanding the hidden structure of the financial system. Let's examine the process step by step. Imagine you deposit $1,000 in a bank. Most people think this money is kept in the bank's vault. But in reality, the bank is not obliged to keep this money. According to the principle of fractional reserve banking, it's sufficient to keep only a small percentage of deposits, say 10%, as reserves. It can lend the remaining $900 to someone else. When this borrower spends the money, it enters the seller's bank as a deposit. That bank applies the same rule, sets aside 10% and lends out the rest again. As this cycle continues, your original $1,000 real deposit can create up to $9,000 in new digital money as it circulates through the system. Everyone sees money in their account. Everyone feels like they're getting richer. The economy appears to be growing. However, most of this money is actually just digital records and chains of claims stacked on top of each other. As long as the system operates with confidence, there's no problem. Everyone is happy. Debts are being paid, the economy is expanding. But the moment confidence is shaken, when everyone wants their money back at the same time, the truth emerges. Most of that money never existed. The bank runs that plunged America into the Great Depression in 1929 were precisely the result of this dynamic. The 2008 global financial crisis reflected the same fundamental problem. After World War II, the world economic order was restructured with the Bretton Woods system. In this system, the American dollar was pegged to gold, and all other currencies were indexed to the dollar. Theoretically, behind every printed dollar was physical gold reserve in the vaults at Fort Knox. This system operated stably for about a quarter century. However, by the late 1960s, the system began to strain. The cost of the Vietnam War, Domestic social spending and growing trade deficits depleted America's gold reserves. In August 1971, President Richard Nixon appeared on television and made an announcement that would change the world economy forever. America was closing the gold window. Dollars could no longer be exchanged for gold. To grasp the full meaning of this decision, one must pause and think. From that moment on, the modern world completely transitioned to fiat money, that is, money based on trust. No central bank was required to hold a physical asset backing the money it printed. The value of money now rested solely on state authority and people's collective faith in that money. This decision was one of the most profound economic transformations in world history. From that day forward, governments could theoretically print unlimited money. The only limits were the risks of inflation and market loss of confidence. The abandonment of the gold standard also meant that debt creation capacity would expand exponentially. For this system to remain standing, a mathematical necessity emerged: continuous, uninterrupted growth. Why? Because debt-created money demands interest. When banks extend credit, they ask not just for the principal, but for the principal plus interest. But here's the critical point: the interest money is never created. Only the principal is injected into the system. Therefore, the total amount of debt in the system is always mathematically greater than the available money supply. For both debt and interest to be paid, more credit must be extended, meaning more money must be created. The moment this cycle stops, the system locks up. Debts cannot be paid. Banks suffer losses. Credit markets freeze. This is why central banks, governments, economists, and international financial institutions always repeat the mantra of growth. When asked if the global economy is sustainable, the answer is surprising: only as long as it keeps growing. If growth stops, debts go unpaid, financial contracts collapse, unemployment rises, and every layer of the system is shaken. This is not a choice, but a mathematical necessity. Pension systems constitute one of the most visible and most fragile examples of this structure. Most people retiring today think they deposited money into a vault throughout their lives and are now getting back what they saved. But the reality is nothing like that. Those vaults are empty. Pension payments are financed by Social Security contributions paid by the young generation currently actively working. This is the demographic version of the pyramid. As long as there is sufficient numerical growth at the base, that is, in the working young population, the system operates smoothly. However, in Japan, Italy, Germany, and increasingly in the United States, birth rates are falling, lifespans are lengthening, and the proportion of elderly population is rapidly increasing. In Japan, sales of adult diapers have now surpassed baby diapers. This is not just a demographic curiosity. It's a concrete indicator of the mathematical unsustainability of pension systems. With each passing year, fewer young workers must support more retirees. What could be the solution? Either you find new participants, meaning you import young population through immigration, or you borrow more, loading pension promises onto the backs of future generations, or you let the system collapse. Governments never choose the third option because it means losing elections. When crises arrive, the real pyramid architect that steps in is the central banks. In 2008, the world faced the biggest financial collapse since World War II. The mortgage market collapsed, giant investment banks like Lehman Brothers went under, and global credit markets suddenly froze. The system truly reached the point of collapse. At that moment, the Federal Reserve and other central banks made an unprecedented intervention in modern economic history. They called it quantitative easing, but what they actually did was digitally create trillions of dollars and pump them into the system. They bought toxic mortgage assets, cleaned up banks' balance sheets, drove interest rates to zero, and artificially kept markets standing. Old debts were paid with new money. Losses were socialized, profits remained private. The pyramid didn't collapse. Instead, it was rebuilt larger, more inflated, and ironically more fragile. In the 2020 pandemic, the same process was repeated on an even larger scale. Governments and central banks carried out perhaps the largest monetary expansion in history. The result? The answer to the question of why inflation never stops lies right here. Inflation is not an unexpected side effect of the system or a policy error. It is the direct and inevitable consequence of the system's survival mechanism. Central banks use the same medicine every time a major crisis comes: print more money, create more liquidity, calm the markets. But when new money enters the economy without real value production, the purchasing power of existing money mathematically decreases. Wages, pensions, savings accounts silently erode, prices rise, and the cost of living increases. Inflation is the cost of keeping the pyramid standing for one more year. From whom is this cost collected? From the financial institutions at the top. From the elite bankers who run the system? No. From the ordinary citizen, from the small saver, from the worker. The system protects itself, socializes risk, externalizes costs. This is not a design flaw. On the contrary, it is the system's fundamental feature. History has shown with merciless clarity how such structures end. In 1720, England's South Sea Company bubble attracted thousands of aristocrats and investors with promises of astronomical returns. The company had virtually no real assets, but collective belief was so strong that stock prices continued to rise for months. The system inflated more, and finally, when it became clear that it had no real foundation, it suddenly burst. Even Isaac Newton lost money in this bubble. The same fundamental dynamic repeated in 1929 in the Great Depression. Excessive speculation in the American stock market, credit-based stock purchases, and baseless optimism led to a giant bubble. When the bubble burst, not only did stock markets collapse, banks failed, factories closed, unemployment reached record levels, and the world entered a decade-long economic depression. In the 1980s, Japan experienced both real estate and stock market bubbles simultaneously. Land prices per square meter in Tokyo were worth more than the entire state of California. People were taking 100-year mortgages. Then in 1990, the bubble burst, and Japan entered a long period of deflation and stagnation known as the lost decades. In every example, the common dynamic is this: systems requiring continuous new money flow, continuous new belief, and continuously increasing participants collapse mercilessly when they face reality. Today, global debt has surpassed 3 times the world's annual economic output. The total figure has exceeded $300 trillion. To understand this astronomical figure, let's do a thought experiment. If the entire world devoted every good and service it produces in a year to paying debt, it could only cover 1/3 of the debt. For the remaining 2/3, 2 more years of uninterrupted work would be needed. But during those 2 years, new interest will have accrued, new debts will have been added, and total debt will have increased even more. Because the system cannot stop. Why does debt constantly increase? Because stopping means immediate collapse. Politicians gather at international summits, economists write reports, central bankers search for solutions. But every time they arrive at the same conclusion: more debt, more growth, more money creation. No one dares to hit the brakes, because braking means crashing. The answer to the question of how the global economy actually works is not found in the simplified models taught in financial textbooks. The real operating mechanism consists of building debt upon debt, promise upon promise, future upon future. The system is designed to expand infinitely mathematically, but there is no such thing as infinite growth in the universe. On a finite planet, with finite resources and finite population, infinite expansion is not possible. Every pyramid eventually struggles to find new participants. Every bubble eventually bursts. The only critical difference is this. This time, those sitting at the top of the pyramid have tools Charles Ponzi never had: state power, money printing authority, tax collection capacity, and geopolitical intervention capability. These tools can delay collapse, postpone it, shift it to other geographies, but they cannot change the structural logic. The winners of the system have always been the same throughout history. Early participants, meaning founding generations, bought cheap real estate, borrowed at low interest rates, and comfortably watched their assets appreciate. Banks collected interest on money that never existed. Corporations artificially inflated stock prices through debt-financed stock buybacks. Senior executives cashed in stock options. Politicians collected votes with promises future generations would pay for. So, who are the losers of the system? The latecomers. Today's young generation trying to buy housing at astronomical prices, graduating with high student debt, working in low-wage and precarious jobs, and not knowing if they'll be able to retire. They are the generation at the very bottom of the pyramid, carrying on their backs the energy flowing upward. The hidden structure of the financial system, once seen clearly, can never become invisible again. Every debt is a promise pulled from the future to the present. Every central bank intervention is the postponement of collapse to another day, another crisis. Every wave of inflation is the system's effort to feed itself, to survive one more year. And this process continues until new participants are exhausted, collective confidence is shaken, until even printing money no longer works. History knows this ending very well. Only the timing and what the triggering event will be is uncertain. The global economy is not legally a pyramid scheme. No one will go to court. No one will be tried for fraud. Because the laws protect, legitimize, and ensure the continuation of this system, but the structural logic rests on the same foundation as the system Charles Ponzi established in Boston in 1920. A structure standing upright with energy constantly flowing from bottom to top. An order requiring continuous new money, continuous new participants, continuous new borrowing. And the only thing history teaches us is this: such structures, when the base weakens, when confidence cracks, when even new money can no longer feed the system, collapse suddenly and mercilessly. To mistake a pyramid for a solid foundation is to passively await being buried beneath it when it collapses. History doesn't repeat itself, but it rhymes. And the rhyme of this system is crystal clear to those who look at history.